Hello, and welcome to another edition of Wealth Management Insights. I'm Lisa Shalett, Chief Investment Officer for Wealth Management, and today is Monday, April 28th, and I'm recording this from my office in Purchase, New York. On again, off again, policy announcements from the White House over the past month have driven historic levels of volatility in markets. Although recent reassurances by Treasury Secretary Bessent on trade and Fed independence have been welcome and volatility has pulled back from extremes, we're not convinced that resolution of tariff uncertainty alone will be enough to catalyze a new bull market. In the contrary, in our view, the main event in markets is not simply tariff fears. Specifically, underlying dynamics suggest that investor anxieties persist on other dimensions. Consider the unusual positive correlation among U.S. equities, U.S. Treasuries, and the U.S. dollar. We've seen simultaneous weakness among them, with surging correlations indicating a global rebalancing away from America. In the extreme, this dynamic might be calling into question the historic safe haven status of the dollar and U.S. Treasuries and the durability of the American exceptionalism theme. But more likely, it indicates a reassessment of U.S. risk premiums related to two key issues. First, concerns about near-term stagflation that could squash corporate profit margins, and longer-term issues about U.S. debt sustainability reflected in the real cost of capital. On stagflation, we observe significant yield curve steepening with a material inversion of the inflation break-even curve, a scenario that contemplates slowing economic growth and higher inflation in the near term, a scenario that is dangerous for both stocks and bonds. Also, we note the market's clear focus on U.S. debt sustainability, given the upcoming tax bill and budget resolution discussions, alongside the need for a debt ceiling expansion. Here, potential tax legislation scenarios include increasing the U.S. debt pile over the next decade by anywhere from $1 to $4 trillion. Such an outcome could double the government's annual interest costs from the current $1 trillion per year. Also importantly, we believe that even if there are tariff deals, they're likely to prove disappointing without a comprehensive rollback. Consider that much touted bilateral deals with Japan and India are actually still months away, with key summits scheduled for June and October, respectively. And then there's the issue of China, which we think will continue to play hardball. The country has several strategic cards to play, as well as the political leeway to play the long game. China also owns about $800 billion of U.S. Treasuries. And while there is no evidence that it is selling, the country could easily be driving global diversification towards gold as the reserve currency. Perhaps most importantly, in the very short run, China is experiencing deflation and thus can afford a very aggressive monetary policy that stimulates what is already a weak consumer economy to help them wait out the American negotiation. So given these dynamics, we believe the environment remains a trader's market, not an investor's one. At this time, consider maintaining maximum portfolio diversification by asset class, by sector, and by region. As for the S&P 500, long-term investors should consider 5,100 to 5,500 a defensible entry zone as long as recession is held at bay. That said, equal weighting or active stock picking is still preferred to passive index buying. And finally, we have rebalanced style biases back to neutral, focusing on quality growth names with achievable earnings estimates. We see value in the belly of the Treasury yield curve, and we suggest scouring the municipal sector for opportunities in bonds. Thanks as always for listening, and for more information on portfolio strategies as well as financial planning, please reach out to your Morgan Stanley financial advisor.